In order to understand the impact of commodity taxes, we need to first understand the meanings of these few terms. So let's begin with commodity tax, which is nothing but a tax that is imposed on the buyer or seller of a good that is being bought or sold in the market. So an example of a commodity tax would be the local sales tax that we pay whenever we buy something at the store. Commodity taxes are to be distinguished from other kinds of taxes that we pay. The income tax, wealth tax, corporate tax, capital gains tax. What's capital gains? Let's say that you buy a stock or a bond for $10 and a year later sell it to someone for $12. Then you are said to have made a capital gain of $2 and you have to pay the government a capital gains tax on that amount. What is the incidence of a tax? It's basically who that tax affects and by how much. So here's an example. Suppose that in the market, apples are being sold for $2. There is currently no tax, so $2 is the amount that the sellers are receiving, and $2 is the amount that the buyers are paying. Now suppose the government introduces a tax on apples. So every time the seller sells an apple, the seller got to pay $1 tax to the government. In this case, we would say that the seller is experiencing the legal incidence of the tax. The seller is legally responsible for writing the check to the government in order to pay this tax. Now, what is going to happen to the equilibrium price as a result of this tax? It's probably going to go up because the tax has increased the cost of doing business for the seller and they'll have to increase prices. Now, by how much will the price rise is a topic for another video. But in this case, let's say that the price rises to $2.75. So now this is the new price that the buyers have to pay. This is also called the net price. That is the price paid by the buyer after the tax. As you can see, the buyers are paying 75 cents more for their apples, and as a result, we can say they are worse off by 75 cents. What about the seller? Is he or she made worse off? Let's see. He or she gets $2.75 from the buyer, but then has to pay $1 tax to the government. So he or she actually gets to take home only $1.75, because out of that $2.75, $1 is given to the government. So the net price received by the seller is $1.75, and as you can see, he or she is worse off by 25 cents because that's how much less he or she is receiving. So the seller is made worse off by 25 cents. The buyer is made worse off by 75 cents. These amounts are called the burdens of the tax for the seller and the buyer respectively. They're also called the actual incidence of the tax as opposed to the legal incidence of the tax. Legal incidence of a tax asks who is writing the check to the government for the tax. Actual incidence of the tax asks who is made worse off by the tax. As you can see, even though the legal incidence of the tax is only on the seller, the actual incidence of the tax is experienced both by the seller and the buyer. And in this particular example, the buyer experiences a greater actual incidence of tax, even though the legal incidence of the tax is completely on the seller. Now, what determines who is going to experience the greater burden of the tax? That again is a topic for another video. Let's now look at what tax revenue means. It's the total amount collected by the government as a result of this tax. It's equal to the tax per unit which in the previous example was $1 per apple, and let's say that 500 apples were sold after the tax. So the tax revenue is going to be $500. It's also often called the government revenue.